Let's talk about taxes, but maybe not in the way you're used to. We're not just going to focus on what you pay. Instead, we're going to look at how the government uses tax incentives as a powerful set of tools to really steer the whole economy. So come on, let's open up that toolbox.
It's the million-dollar question, right? You always hear about certain companies or entire industries getting these big tax breaks, and it can all seem super complicated, maybe even a little unfair. But here's the thing. These are all totally legal mechanisms written right into the tax code. So today, we're going to untangle exactly how these tools work.
You know, the best way to think about all this is to imagine a government toolbox. Every single tool in there, an exemption, a rebate, a tax holiday, is designed for a very specific job. Maybe it's to encourage someone to build a new factory, or to support farmers, or even to promote charitable giving. It's basically the government's way of saying, hey, if you do this thing that we think is good for the country, we'll give you a discount on your taxes.
All right, let's pop open that toolbox. The first couple of tools we're pulling out are exemptions and exclusions. Now, these are all about income that, for tax purposes, you can legally just, well, pretend doesn't even exist.
Okay, so what's the difference? It's subtle, but it's really important. An exemption, which is covered in Section 76, makes an entire stream of income, let's say from a specific kind of business, totally invisible to the taxman. The tax board has to grant it, and they can also take it away. Now, an exclusion under Section 77 is different. That's a specific amount you get to subtract from your total income. Think of a donation to charity, and that's usually capped, for instance, at 10% of your income. So one makes an income source disappear, the other just shrinks the final number.
So who actually gets these exemptions? Well, Section 79 gives us a perfect example. Cooperative societies. To help support agriculture and small-scale businesses, the law basically says that any money these societies make from growing crops, running a cottage industry, or helping their members sell produce is completely 100% tax exempt.
And listen, the law is super specific here. When it says cottage industry, it's not talking about just any small business. As you can see right here from Section 79, it's got to be an enterprise where the owner is the main person doing the work, there's a strict cap on machinery investment at 25 lakh taka, and the whole team, family included, is 15 people or less. This makes sure the benefit goes exactly where it's intended, to those truly small, owner-run businesses.
Okay, time to grab the next tool from the box. This one's a rebate, and it's a totally different animal from an exemption. If an exemption means you ignore some of your income, a rebate is a straight-up discount on the final tax bill you've already figured out. It's like having a coupon you get to use at the very last step.
So how do you figure out how big your rebate is? Well, Section 78 gives us this little three-step formula. First, you calculate 3% of your eligible income. Got that number? Good. Next, you calculate 15% of your eligible investments for the year. And finally, you have to keep in mind that there's a hard ceiling. You can't go over 10 lakh taka. So now you've got three different numbers sitting in front of you.
And here is the catch. This is the crucial part. You don't get all three, you don't add them up. The law says your tax rebate is whichever of those three amounts is the lowest. It's a clever way for the government to encourage investment, but also put a very clear limit on how much of a benefit you can actually get. All right, now for the heavy hitter. This is the biggest tool in the whole box, the one that gets all the headlines, the tax holiday. This is a massive incentive, and it's designed to do one thing: attract huge investments and create a ton of jobs by giving certain businesses a complete break from paying taxes for a while.
Now, the key phrase you need to remember is approved tax holiday entity. This is not something a business can just decide to take for itself. Nope, you have to apply for it, and you have to be officially approved by the National Board of Revenue. It's a formal status that gets you a full or partial tax break for a set number of years.
And the list of who's eligible, which is laid out in Section 81, is pretty strict. We're talking about real, registered companies with serious capital. But here's the most important part. It has to be a genuinely new business. You can't just take your old company, give it a new name, and call it a day. And you have to be using new machinery. The whole point is to encourage brand new economic activity, not just to reshuffle what's already there. The process for getting approved, laid out in Section 82, is actually really clear. A company applies within 6 months of getting started. Then, the board has 60 days to make a decision. But get this, if the board doesn't get back to them in time, the company is automatically considered provisionally approved. It's a really smart rule to stop applications from just getting lost in a bureaucratic black hole. Of course, anytime you have a benefit this huge, you've got to have rules to stop people from taking advantage of it. And one of the most important ones is what we can call the fair price rule. It's all about stopping companies from artificially moving their profits around to avoid taxes. Section 83 explains this perfectly. It says that if a company that has a tax holiday sells something to its own sister company, it has to do it at the open market price. What's that? It's basically the price two total strangers would agree on. This stops the company from doing something sneaky, like selling its products to its sister company for a ridiculously high price just to pack all the profits into the tax-free business. If they try, the tax authorities can step in and say, nope, we're adjusting that income to what it should have been.
So we've seen the tools in the box: exemptions, rebates, and these big tax holidays. But you know, every tool comes with an instruction manual. All of these tax breaks are conditional. If you don't follow the rules to the letter, you don't get the benefit. Simple as that.
And that brings us to the compliance checklist. These rules apply to pretty much anyone who wants a tax break of any kind. You have to file your tax return on time, period. You've got to handle your employee taxes correctly, and for transparency, almost all exempt income has to come through a bank. These are the absolute, non-negotiable basics of playing the game.
And what happens if you don't follow the manual? Well, the consequence is simple, and it's severe. If you don't meet those compliance checks in any given year, the Deputy Commissioner of Taxes has the power to just cancel your tax benefit for that year. It's a reminder that this incentive is a privilege, not a right, and it's tied directly to being a good taxpayer. So there you have it. The tax code isn't just a rule book for taking your money. It's a really complex toolbox, filled with incentives designed to build and shape the economy, encouraging everything from a tiny cottage industry to a massive new factory. The law gives us the tools, it gives us the rules for using them, and it tells us the penalties for breaking them. Which, of course, leaves us with the really big question. Are these tools actually working? Are they building the kind of economy we really want? And that, my friends, is the real bottom line.